Welcome to the Retire with Peace podcast, the podcast where we help you create a fulfilling and stress-free retirement. Each week, we bring you expert advice, practical tips, and inspiring stories to help you plan and live your best retirement life. Whether you're nearing retirement or already enjoying your golden years, this podcast is here to support you every step of the way. Let's embark on this journey together and discover how to retire with peace.
Welcome back to the Retire with Peace podcast. As always, I'm your host, Dave Zegel, and we're going to talk a little tax planning today because it is the season to do lots of tax planning. Really, when we're working with clients, we do tax planning all throughout the year. But this time of year in particular, we are narrowing down what tactics we are going to use to help with our much longer term strategy. In this case, we've been doing a lot of donations of stock to charitable organizations because donating to charity is good anyway, and people are doing that. At least a lot of our clients are doing that. So we went to look at this and say, how can we get the most out of the charitable donations we are making, especially in certain years of our tax planning? So let's first start with what donating stock is, and then we can talk a little bit about why we would do that and why we would do that in certain years of retirement planning. You are allowed to donate cash, stock, mutual funds, exchange-traded funds. Really, there's not a whole lot you can't donate to charity. But when we're talking about tax planning, there's different orders of helpfulness, we'll call it, in terms of what it can do from a personal tax planning, where we have to look at what is the best vehicle to use to provide these charitable organizations with the donations. So you can donate cash, totally fine. Write them a check, send them an ACH, send them a Venmo, hand them a dollar bill or two, I don't know, whatever you want to do. You can just donate cash to charity, and there's nothing wrong with doing so. But in a lot of cases, especially as we get closer to and into retirement, there are way better ways to make donations. We've talked about some on this podcast before with charitable, qualified charitable distributions from IRAs and things of the nature. But right now we're seeing a lot of donations of stocks because the stock market has had a great year in 2024. So as long as you've held on to that stock or that fund for at least 12 months, you can donate it and thereby get rid of all of the potential capital gains taxes that you would pay on that particular security. So if you've held this for more than a year and you've had a gain, if you sell that, which is what usually people would do, if you sell it, then you pay capital gains tax on that gain in the stock. So a lot of times people will sell it and then they'll donate the money, which is big no-no. Don't do that. It's not that it's not allowed. You're just not really taking advantage of all the tax rules that are there for you. Instead of selling the stock and donating the cash, just donate the stock. You still get a charitable contribution and you're avoiding capital gains tax on that investment. This is not stock that's in an IRA account because that doesn't matter for capital gains. This is stock or any asset really that is not inside a retirement account that has gone up in value. You've held it for more than a year, and now you're looking for how am I going to best donate money to a charitable organization. Donating that stock or that fund is a great way to do it, to still get your charitable donation deduction, but also get rid of the capital gains that you would otherwise be charged on a tax return if you sold the investment. So let's go through some concepts of how this can benefit you from a tax perspective. Because the initial pushback is, well, I'm at a standard deduction, so why would I donate stock instead of cash? Because I'm not going to get any extra benefit to doing so, which in terms of the itemized and standard deductions is true, but you're still getting rid of that capital gains piece, which is great. That's extra tax savings that you otherwise wouldn't get if you wound up selling it down the road. So even if you're at a standard donation, standard deduction, this donation can provide some benefit to you. Now, when we're talking an even bigger picture strategy, there are certain times where you might want to donate a whole bunch all at once to make sure that you have enough deductions to get above the standard deduction on your tax return. And just to back up for one quick second on itemized versus standard deduction. So on your tax return, you have what are called itemized deductions. So it's the total of state and local taxes, which right now is capped at $10,000, but state and local taxes, mortgage interest, and charitable donations. Those are essentially the three big ones. There's some other stuff that's not too likely, but state and local taxes capped at $10,000, mortgage interest, and charitable donations. If all of that totals more than your standard deduction, then you get the higher of those two amounts, whichever one it is. So a lot of times people might say, well, my house is paid off and my charitable donations aren't going to get me up above the standard deduction, so forget it. I'm just not going to worry about it. There's still tax planning to do, like we just talked about, getting rid of the capital gains on that stock or whatever asset it is that you've held for more than a year that we want to avoid capital gains tax on. But a lot of times we will get situations, and we're working through a couple of these right now as we speak, where it's the last year that somebody is working. And we know that when they stop working, their taxable income is going to go down because they're no longer working. And what they're going to take out of their investment accounts, it might be the same monthly income to them, but the tax structure is going to be very different. Partially just because that's the way they're structured, and partially because of maybe some tax planning that we were able to do before they retired. But regardless, they're in their last year of working, and this is going to be their highest income, highest tax year that they're going to have most likely forever, unless there's some crazy change in tax laws way down the road. So we're trying to maximize how much deduction we can get for them, especially if they're already charitable donation minded, if they know that they're going to be making donations every single year on a regular basis as they have been. We can donate stock and we can identify organizations if we're ready to do so. But even if we're not ready to identify who we want to donate to, we can use a vehicle called a donor advised fund. And you've heard us talk about this on our podcast before, but let's dive a little bit more deeply into it. A donor advised fund allows you to make the donations to this donor advised fund all in 1 year. And then over time, give out the donations to charitable organizations as you see fit. Now, I say as you see fit, there's some rules, some regulations, but generally speaking, if you're going to donate for the next several years, then there's no point in trying to spread out your donations from a tax perspective. You can donate all of it now to a donor advised fund, especially if you have a lot of appreciated assets like stocks or funds. You can get all those donated to the donor advised fund, remove the capital gains, and get all of the charitable donation in the current year when you're going to have a high income that you want to offset. Then in future years, when your income tax is lower and you're just at a standard deduction every single year, you don't have to worry about, oh, gee, am I going to do a charitable donation? What's my deduction going to be? All this stuff. You've already done the donation to the donor advised fund. You got a huge tax benefit in this 1 year. Again, especially if it's your last year of working and your income tax is high, you can get all the tax benefit right now, remove capital gains taxes from those investments, and then over the next several years, you just direct the charitable contribution, the charitable donations from your donor advised fund. It's a great way to take advantage of the tax laws and still get a lot of charitable donations made over the years. And at the same time, you're not trying to figure out year to year how much you're going to donate versus the standard deduction and all this stuff. That's already done. We've planned for this. We're offsetting tax in the highest income year. We're getting rid of capital gains tax, and we're getting money in the charitable organizations, easy for me to say, organizations' hands over several years. And it doesn't even have to be over several years. It could be next year if you want to. There's no rule that says, oh, you have to spread this out. You can make the donations whenever you want. These are just really nice vehicles to where you can put the donation in and decide later exactly where you want to donate. So as we're getting towards the end of the year, if you're sitting here with stocks or funds with a whole bunch of gains and you've held them for more than a year and you're trying to offset your income, use some of these strategies to figure out how can I maximize offsetting my income, still make the charitable donation deduction, and everybody wins, except for the government. They don't win. Oh, well, darn. But you're benefiting by being really, really good tax planning wise and tactically planning for your taxes. The charitable organizations are still getting the donations that they would need to survive. Everybody wins. So we just need to look at this more strategically than just handing out cash every single year. Let's say, what rules can we take advantage of to get even more money, both in our pockets and in the pockets of the charitable organization? Win-win all the way around. One other thing that I'll mention, we're recording this from Missouri. Some states have these programs, others don't. But in Missouri, there are certain charitable organizations where you can also get a Missouri tax credit for donating to them. In some cases, that could be 50%. We've had Room at the Inn on this podcast before where they provide 75% Missouri tax credits. So for every dollar you contribute, you're going to get 75 cents back on your tax return as a tax credit. And there are limits to this. It's not unlimited. And we're not going to go through all the rules because we've covered this before. But I bring this up to say, well, maybe at least a portion you could donate to someone like that, or like a food bank. There's all sorts of different organizations, not going to go through all of them, but be mindful of that with your charitable contributions also, because there are a lot of states that will provide these tax credits on your state tax return at the end of the year for making donations to these particular organizations. So I bring that up just as another way to say, hey, how can I maximize what we're getting out of these donations? The charities are still getting their money. Great. How can we benefit also from a tax perspective, even more so than just handing them cash and not really knowing what we're doing strategically? So keep those things in mind, the state tax credits, but especially donating appreciated stock or funds. Since we've had a great year in the stock market, there's a lot of people sitting on gains that we can get rid of from a tax perspective, still get the money in the hands of the charity. And again, everybody wins. Thanks so much for tuning into this episode. I really appreciate your support and hope you found value in the conversation. If you enjoyed it, be sure to subscribe, leave a review, and share it with someone who might benefit from it. Your feedback helps keep the show growing. Until next time, take care and stay strong as we learn